Brian, it's really interesting to see this shift in expectations, right? Now, a higher for longer narrative at play here. And this comes despite recent commentary from Fed officials that they'll continue to cut rates, at least in the near term. So what does this all tell us about what investors are thinking about the long-term outlook for markets and what the Fed ultimately decides to do?
Yeah, all eyes remain on the Fed right now, even though we're entering a very important earnings season. But from a macro level, the Fed still controls the direction and the level of markets. And there's two things to think about. One, in the short term, where are we going with inflation expectations and what's happening with the labor market? Is supply demand truly in balance, allowing the Fed to have optimism that inflation is coming lower and they continue on this rate cutting path? My view is they probably want to pause here, digest some more data, and not be bullied into an additional 50 basis point cut coming up in the next month or two. But longer term, one of the big issues that I'm struggling with is what happens if the Fed loses credibility? Their ability to control inflation or to use policy tools to drive inflation expectations is in part relying on investors and consumers' belief the Fed has visibility, has this unique knowledge. And if all of a sudden the labor data moves the wrong direction after this recent cut, or the inflation data bumps back higher, the market needs to quickly reprice inflation expectations going forward, reprice the bond market with yields moving higher, which will probably lead to an equity market pullback as well. So I'm a little bit worried about Fed credibility as we enter these next few significant data points.
Brian, you mentioned inflation a few times, and it's moderated, but like you suggest, a potential resurgence in price increases, that's a big concern for investors. How do you view the inflation story? And is there a way for investors to position their portfolios to hedge against that possibility?
Yeah, I view it as two issues here. One is supply side issues, which the Fed really can't control, right? We have issues with geopolitics that could lead to commodity price inflation if wars were to expand from where they currently are today. We have issues around labor strikes, which could cause supply issues. That could put upward pressure on prices, and the Fed has very little control of that. There's also the demand side where they have more control. And we have a fiscal situation here where both parties seem to want to spend a lot of money, at least they say they're going to. That's going to put upward pressure on demand. It's going to put upward pressure on prices. And the labor situation is still not fully in balance in my mind. We might have quantity in balance, but maybe quality isn't quite where it needs to be. And so I think there's a two-headed issue here for the Fed to deal with. Part, they can probably help on their own. Part, they're going to have to just accept the reality, but it's a concern. So from an investor standpoint, build a portfolio that's balanced. Don't rely on any macro outcome, whether it's inflation or GDP, build a balanced portfolio with both defensive and offensive holdings within it.
And speaking of having a balanced portfolio, we've seen this recent rotation out of mega cap big tech stocks into other areas of the market, like utilities, for example. Do you think there's still more to room to run with that rotation story? And are there other sectors that you're very bullish on at the moment?
I think there's a lot of room to run in this. We've seen growth stocks in general do really well the last 12 to 24 months, and I think with good reason. But starting in Q3, that rotation began. The market has been chasing a small group of stocks, both for exuberance reasons around the AI trade, but also fear reasons. The fear around the Fed making a mistake, causing a recession. And so investors are pushing capital into a very small group of stocks, the ones we all know that dominate the top of the S&P 500. Valuations up there got really expensive in my mind on a relative basis. Now, there's also good reasons for that on an earnings front. The Mag 7 in 2024 had earnings growth that was 25% above the growth rate of the rest of the S&P 500. That growth rate shrinks to 5% in 2025. And so investors need to stop that and step back and say, am I paying too much for businesses that are great, but ultimately not going to be growing much faster than the broader market? And so what I think should happen is investors will become less greedy about the AI trade. They'll be less fearful about the macroeconomic event eventually. And they're going to rotate into what I think are value stocks. And the value rotation will help support industrials, materials, healthcare, utilities, and even bank stocks.
And speaking of that, you do have some mid-cap names that you like. You say those are underrated. What are those stocks? And what's the benefit of going for a mid-cap name versus a mega-cap stock like an NVIDIA?
Yeah, mid-cap stocks and mid-cap companies tend to be in the sweet spot of their life cycle, right? We have a lot of challenges as infants, whether it's humans or as companies, getting through the riskiest phase. A lot of upside, but a lot of challenges. Once you become a big company, it's really hard to move the needle from things you control. There's only a small subset of companies up cap that really have that ability. In the middle of our life cycles, when we have the most ability to control our destiny with the least amount of relative risk. And so mid-caps tend to do quite well. Today, we want to own are companies that have the ability to have secular drivers and elements that they can control that are maybe being overlooked due to cyclical issues. So one example is in the packaging space. Graphic Packaging is a company that's moving up the quality scale when it comes to their cash flow stability and predictability. They've sold off more of a commodity piece businesses. They've invested through CapEx and R&D in areas that will allow them to, one, lower their cost to manufacture, to be the lowest cost provider in their entire market. And two, the R&D gives them unique innovation that drives pricing power. The result of this will be a more stable, predictable, higher quality cash flow stream with better margins, and ultimately the ability to use their own capital then to give it back to us as investors through buybacks or even to grow through future acquisitions. I think that's mispriced today in their stock.
Bryant VanCronkhite, Allspring Global Investments Senior Portfolio Manager, thanks so much for your insights today.
Pleasure.